Coming up today, Roaring Kitty's $500 million position, his upcoming live stream, did E-Trade violate federal law, an update on NVDA, the ECB cuts rates while increasing their inflation forecast, and a preview of the upcoming jobs report tomorrow. And there we go again, guys. Higher highs, higher lows, and the S&P 500 coiling up in a narrow range day as we go into the big jobs report tomorrow. S&P 500 currently at 53.52, but on really anemic volume. In fact, I think we're hitting a record today on a non-holiday trading day for the lowest amount of volume here on the SPY. 30 million units traded versus the average 47 million. Not necessarily a bad thing as the market's drifting higher. Low volatility and low volume. Market breadth's still not all that great though. Most stocks not ripping up to highs like the main indices are. In fact, more than half of all S&P stocks still below their 50-day moving average. But volatility still very low here, 12.5. Even the VIX 1 day tomorrow's only priced at 13.3. Option dealers not too worried about tomorrow's jobs report. I'd say it's likely to come in a little soft. However, stick with me today and I'll get more into that later, along with a few other interesting things. And just a quick reminder, if you find value in these videos, then go ahead and show some love to the algo by hitting that like button, and you'll be helping to support my effort and bringing you these videos every day. And let's dive right into the number one story everyone's talking about today, and the diabolical twist it's taken again, and GameStop ripped up a whopping 47% today and regular trading on a massive 193 million shares traded. And look at that, still going for a run after hours as I speak, adding on another 15%, currently trading at 53.80. And so the squeeze is on, and after it had long been given up on, I think in 2021 was the height of meme mania craze, here we are 3 years later going through it all again. And I'd say this time is even more interesting with a lot more at stake as well. And the guy who started all this madness, Keith Gill, aka Roaring Kitty, just posted an update on Reddit about an hour ago as I speak, confirming what I thought yesterday. He's still a hodling, 5 million shares, 120,000 call option contracts, now valued, together with his cash position, at a whopping $586 million. This is a suburban retail trader who happens to like cats, who's now up there in the big leagues, has got more shares than the best traders in Congress. Adding further to the buzz in the financial internet today is the fact he's just scheduled a live stream on YouTube during tomorrow's regular trading session around lunchtime. And that is going to be huge. And this is the thumbnail he's uploaded for that. This is a famous meme here in which he's placed a cat, kind of emphasizing a lot of regulators, politicians are really on top of him. Looking at him for this green candle for optimism, bullish hope, with the text, "I'll wager with you, I'll make you a bet." Who knows what he's going to reveal live on stream? Maybe he exercises his options. Maybe he just talks gibberish about cats. Maybe he places a fresh buy order. But I've got to hand it to the guy, he certainly has guts. He's added this big disclaimer to this video saying he doesn't provide personal investment advice. It's for educational entertainment purposes only. However, the regulators, Wall Street, SEC, everybody is going to be watching this, and he's going to be scrutinized out the wazoo. So he's certainly game going ahead with all this, and he just happens to be doing it a day before his 38th birthday, the following day. And this has absolutely lit up the options market in GameStop. Out of the money call options going like crazy, with strikes going all the way up to $128 a share, and average implied volatilities around 340%. And so how you can work out what the expected daily move is from the options market using implied volatility is you divide IV by 16. So the options market going into regular monthly expiry on the 21st this month, third Friday of the month, the options market's expecting the average daily moves in GameStop shares to be around 21% a day, which is absolutely ridiculous. Volume's off the charts. Put call ratios super low, meaning people are piling into calls here. Market makers certainly got their job cut out for them, and that's why they've marked up their IVs to about as big as you'll see them on a highly traded share. And we're already hearing the cries coming out of short sellers like Citron Research and Andrew Leff also piling on, saying there should be an investigation. What he's doing's illegal. Only guys like him are allowed to come out and promote their positions online, influence the stock price. How dare someone else do it to him? And maybe he didn't learn from the first round when he got burned shorting GameStop back in 2021. And so for most of us, we wouldn't have $500 million just in GameStop, which is still a struggling business. However, it seems like Keith Gill's on a mission from God. Maybe it's not all just about the money for him. Maybe he's trying to make a point. Maybe he wants the spotlight. Maybe he's happy to go to court. Maybe he will exercise his options live on air and see whether the street can deliver 12 million shares into his account. Looking at his cash position, he wouldn't have to sell all of his shares either. So there'd be a huge imbalance in the market. And looking at some data, it appears the biggest option dealers on the street, as of last reporting, don't even have 12 million shares to be able to deliver to him. Because when an option dealer sells you a call, they have to have the shares ready to deliver in case you exercise that call. 100 shares for every option contract. If they don't, that's called naked call writing. Controversial practice in which Wall Street is accused of creating shares out of thin air that they don't have so they can manipulate the stock price in tandem with their friends in mainstream media. So maybe he's putting the squeeze on the street, and maybe he wants to shine a spotlight on the shady practices that he's picked up on, and at the same time make himself and his followers a boatload of money. And since everybody's so righteous and obsessed with sticking to every technicality of the law, maybe E-Trade also stepped over some boundaries as well and violated a federal law on protecting customer data and privacy by sharing details about Keith Gill with the mainstream media. So it could be the street and the whole establishment, hedge funds, regulators, Congress, might actually be a little bit afraid of what this guy is trying to do and expose. And there certainly must be a few closed-door meetings going on right now to try and determine what to do with this guy. And I can tell you tomorrow is going to be one of the most interesting days on the stock market. Finishing out the week, jobs report, Roaring Kitty live on air. What is going to happen? It'll certainly be interesting. And since he's such a smart guy and has covered himself quite well, they tried to come after him last time. They weren't successful in pressing criminal charges. He's not out there telling anybody to buy a stock. It's not illegal to publish your position online. It's not illegal to post memes. And whether people go ahead and buy shares based on that, well, they're adults with their own money. They're free to do what they want. We get influenced all the time from different people and companies as to what to do with our money. It's only a problem if someone like Keith Gill does it. Why? Because he's more effective than the hedge funds. Andrew Left, Citron Research. And I think this meme sums it up pretty well. Hedge funds, Congress, sitting on piles of money, looking down, accusing the little guy of doing the same thing. And who knows, maybe the establishment is successful. They throw him in jail. Maybe Trump gets back in and gives him a pardon. Who knows, anything could happen here. And just getting back to the chart, looking after hours, it's ripping up as I speak. This is crazy, up 24%. $58 a share, just going on an absolute run here. And for it to take out that initial burst after he came back on X, that would be $64.80 a share. And by some calculations, believe it or not, when it hits $69 a share, Keith Gill's total position will be worth $1 billion. This guy could be a billionaire tomorrow. And he started way back in 2021 as a mid-level employee for a regional insurance company who happened to like the stock of GameStop and put all his savings of $50,000 into the positions, now parlayed that into $500 million and potentially $1 billion tomorrow. And maybe it could be a case of a lot of traders taking some chips off the table on NVDA today to put them into GameStop and other meme stocks. Still got a lot of activity in the options market. However, shares did pull back today, so it hasn't quite taken over Microsoft in market cap yet, but it's still right behind Microsoft, ready to take the lead here. One more trading day before they split on Monday. 10-1, along with Apple's Worldwide Developer Conference. NVIDIA initially gapped up today, traded up to $12.55, before finishing a bit lower than the open. We still put in high highs, high lows, a little bit softer after hours as well, and a bit of a similar pattern for Apple, pulling back a little bit here, while Microsoft pretty much trading flat like the market. And there's a long-term look at a clean monthly chart of the S&P 500 ETF, clearly on a March high here, all-time highs, technical bull market for sure. Really tough environment to short in. That's why shorts are at record lows. Short-only hedge funds all but disappeared. Long short funds struggling to keep up with passive indices for years now. Looking back at history and stepping back, just looking at the long term here and now, we are most likely closer to a top than a bottom. And some similarities we have with that late 90s bubble peak is the percentage of stocks that have outperforming the index year to date. Where we are now, getting to similar levels from 98 and 99, meaning it's more of a skinny bull market. Like I showed you at the start of this video, there's not much breadth, still more than half of all stocks below the 50-day average. Really NVIDIA and a handful of other key stocks doing most of the heavy lifting. And it's the opposite whenever the market crashes. Like it did in 01, 02, 08, and 09. You have more stocks outperforming the index than not. However, not is all the same as back in the late 90s. Back then, it was really junk stocks ripping up. All they had to do back then was add .com to their name. Stock would double overnight. Everyone would get excited. There'd be literally companies spending $20,000, $30,000 on some servers, list on the market, and get valued at a couple $100 million, $1 billion. And we can see that. Looking at the lowest 10% of profitable stocks actually made up 12% of the index in 2000. Nowhere near that now. This is a rally led by very profitable stocks. Microsoft, NVIDIA, Apple, absolute cash machines. They print almost the same amount of money as the Federal Reserve. So that's one thing that is materially different, much more quality-led rally opposed to a junk stock rally back in the late 90s. And coming back to the here and now, June, July, and August are historically the best 3 months of an election year. Like I showed you yesterday, the market's never topped out in June for the year, and for this month we actually finish higher 75% of the time with a really huge average return of 7.3% for an election year. July coming in number 2 at 5.2. In fact, there's no average negative months for the rest of the year out. And since we've been hitting all the technicals and seasonalities to start this year, the rest of the year, the odds are looking really good that this bull market continues, especially with a really supportive Fed and Treasury and federal government. Not only liquidity and financial monetary conditions are loose, the biggest driver of stock prices, the fundamentals, are also firm as well. Earnings strength is broadening. EPS growth expected for the second quarter this year has been accelerating. We've already been through the corporate earnings recession. Finished last year, 4 consecutive quarters of negative EPS growth. Now we're getting back to corporate earnings expansion. However, again, stepping back out to the long term. Things are good here and now. Valuations aren't so great. And just looking at this chart of the variability of returns explained by a price to normalized earnings per share. In other words, how much of the returns are determined by starting valuation, looking at a holding period of different years. We're just looking at 1 or 2 years. It's only 10-20% of your returns could be attributed to valuation. However, like I always remind my viewers, in the long term, valuations will make up a large percentage of your returns. In fact, once you get to year 10, your starting valuation will explain about 80% of your return. And that's why I always say valuations matter, just not always in the short term. And following on from Bank of Canada, cutting rates yesterday on the back of Switzerland, which did it 2 months ago, we now got the third largest move from a central bank this year, the European Central Bank, cutting interest rates for the first time since 2019. At the same time saying inflation is likely to stay above its 2% target well into next year, and they actually revised their inflation forecasts higher. And that's why I continue to say 3% is the new 2%. Central banks around the world are joining hands and happy to stay with an easy money stance, not too concerned with structural inflation. And admittedly, we do have a big pullback in oil. That should definitely help further disinflation. However, we still have a lot of money sloshing around out there. Other commodities bumping up, shipping rates bumping up. Would be surprised to see inflation under 2% anytime soon. And just remember, you'd need to see inflation more closer to 1% to try and remove some of that structural embedded inflation we've got over the last couple of years. So as Switzerland, Canada, and the Eurozone cutting rates, certainly makes it easier for the Fed to join the party, as they'd just be following suit. Although the States has much stronger growth and a better performing economy than those other countries. For one reason or another, Treasury yields have been falling firmly the last week or so. We just got to look at initial jobless claims, climbing to a 4-week high. Still not breaking out of a yearly range though, and who knows, maybe one of the best indicators of upcoming recession. Some say the all-time financial indicator, inverted yield curve, short-term bond yields, higher than long-term bond yields. Bond market been forecasting a recession for almost 2 years now, could actually still play out. And there's a look at the 2-year today, 472, and the 10-year. Trying to find support here around 428 with a bit of a pause there for TLT and still more consolidation for high yield bonds. However, if the bond market is forecasting significant economic weakness around the corner, it's not showing up in global composite PMIs, manufacturing and services, clearly in expansion territory and have been trending up these last couple of months. And whilst the consumer has pulled back on discretionary spend, just looking at another key indicator of consumer economic activity, USA TSA checkpoint numbers, amount of consumers going through airports, tracking higher than last year and tracking higher than the last 4 years. Here in the red line, 2024, grey line 2023, orange line 2022. You can see that big dip fall off in COVID in 2020, but it did recover somewhat. So more Americans are traveling now than they ever have before. But it'll be interesting jobs report we get tomorrow. We get the first Friday of every month. Forecast for 190,000 new jobs to be created in May. Unemployment rate at 3.9%. And it's possible we come in at 4%. The market may get excited with that and may start pricing the Fed is cutting rates, who knows, maybe in July. If not, probably taking us to 80-90% chance we'll cut in September. That could spur on a further rally in the stock market. However, if it were to come in at 4.1%, could be a mixed reaction. Likely see bond yields diving as fears of recession will start taking hold, because the unemployment rate's the biggest indicator of recession. And this is a monthly line chart of the unemployment rate in America. Currently at 3.9%. See it there in April 2020 and COVID. Shot up to almost 15%. And if I just overlay when we've had recessions, you can see the unemployment rate has always started turning up before we go into a recession, and something that I've shown on this channel a few times before, and a pattern I've observed. If we overlay this chart with the 20-bar simple moving average, in other words, just smoothing out the trend, creating a moving average of the unemployment rate, that's currently at 3.65, and the unemployment rate actually jumped above the 20-month moving average back in August last year. And looking back in history, pretty much every single time the unemployment rate goes above the 20-month moving average, a recession is around the corner. Happened in 2020, happened in 2007, happened again in 2001, same again in 1990, early 80s, and even in the 70s. In fact, you can find this pattern going all the way back to the 50s and the 40s. And if I just overlay this chart again with the S&P 500 here in the orange line, what you'll also find is pretty much all the time stock market will bottom during a recession. After it started, happened in 2020, happened in 2009, happened in the early 2000s, brief dive in 1990, but it still bottomed out during the recession, and again in the 80s and the 70s, so on and so forth. So the macro setup is inverted bond yield curve, unemployment rate above its moving average, stock market at all-time highs, and that's why I think it's still a really good strong chance we get a recession next year, then the stock market rolls over, because I don't think the powers that be will allow that to happen before the federal election in November. However, after the November election and going into next year, that's when we may see the real pain. And we've already got signals of the jobs market softening. Just looking at small business hiring plans for the next 3 months and just pushing that forward by 7 months. And then looking at the US unemployment rate inverted, very strong correlation between those 2 points of data. And with small hiring plans coming off a lot, the unemployment rate could very well indeed follow that down over the coming months. And it could be very spicy if we do get things blowing up going into November. I'd say the Fed and Treasury are going to be pulling out all sorts of stops to try and kick the can down the road till next year. And so it could be a case the bond market and commodities maybe pricing in some of that economic weakness. In addition to yields, we've also seen oil fall a lot these last couple of weeks. Seem to have found their footing a little bit here today, but still by no means in a technical uptrend, definitely in a technical short-term downtrend at least. Whilst we've got a bit of an uptick in gold there today, and agricultural commodities still holding up above the 50-day as well. Over the economic calendar, there's the weakness in the Eurozone. Germany factory orders, Italian retail sales, and Eurozone retail sales coming in worse than expected, contracting month over month. There's the ECB cutting rates to 4.25. Jobless claims in the States coming in a bit higher than expected, but the economy still holding up. We can see the amount of goods US shipping overseas better than expected. Also, the amount of goods they're buying from overseas better than expected. Still a lot of economic activity. Going out to tomorrow, get a look at GDP growth data from the Eurozone, along with the unemployment rate in Canada, expected to come in at 6.2%, and the big one from the States, 3.9%. Say the market would be quite upset if that came in at 3.8%. Stocks could sell off. However, if I was to guess, maybe based on this recent soft jobs data we've been getting, maybe it comes in at 4%. But let's see what sort of print we get on that tomorrow morning. And the big one next week, Wednesday, CPI core inflation data, along with the Fed's interest rate decision, widely expected for them to stay on hold. And so these probabilities on Fed fund future pricing could change a lot tomorrow after the jobs report. Currently about 70% chance we'll get a cut in September. Like I said, if it comes in at 4% or 4.1%, I'd say we could be getting at least a 50% chance they'll cut in July, and this will probably move to maybe 80 or 90% chance, and the Fed will take whatever chance they can to go ahead and cut rates, just like the ECB and Canada has done as well. Fear and greed index, actually on the cusp of the fear zone, while the stock market's sitting at all-time highs. This goes to show that it is a bit of a skinny bull market and narrow rally with not a whole lot of breadth. And corporate insiders, as usual, playing the contrarian, taking advantage of those high prices and doing a little selling here. There's a look at China, seeming to hold on to its 50-day here. And my favorite, Tiger Brokers, had a great day, up 6.2% on huge volume. This continuing pattern we've been getting over the last month or so. After they just reported earnings yesterday, and not a bad result considering the Chinese bull market's only just started, still hasn't nowhere near got to a middle stage where it's starting to attract the masses. Still a lot of people skeptical and giving up on it. So I still think we're in the early innings personally, but they're doing well, even though they came in a little lower than expectations. Revenue still hit 3-year high, net profit up 42% year over year. Client assets reach a record US $32.9 billion. So they're one of the biggest online brokers in the world now. And like I said, that unique value proposition of offering foreign investors around the world direct access to Chinese and Asian markets, whilst allowing Asian traders access to US markets. Founder-led company, is heavily invested, partnered with interactive brokers, technology and backend, innovative leading trading app, over 2 million customer accounts, and with offices all around Asia Pacific and North America as well. So overall, things are doing okay here for Up Fintech, also known as Tiger Brokers. A little bit of a pullback in clean energy there today, still in an uptrend though. Best performing sector today was gold miners, bouncing off the 50-day along with the underline. And there's a look at Bitcoin, still forming this bullish flag formation, creeping up to this resistance zone. And what you'll see with markets is the more they push up to a resistance or support. You could kind of think of it as weakening that resistance, and the more likely it'll break through it. And so who knows, tomorrow could get real interesting. Going into the weekend, NVIDIA stock split, Apple conference Monday, that could easily be a setup for Bitcoin to get real excited and break out to all-time highs above $74,000 a coin as well. And just the latest look on GameStop. Wow, look at this. Absolutely gone ballistic after hours as I speak. Now trading around $65 a share. This thing is ripping right in front of our eyes. Tomorrow could be huge, and it looks like Keith Gill is on his way to becoming a billionaire. Maybe the first ever retail suburban trader trading his E-Trade account to turn $50,000 into $1 billion. And it looks like we just took out those highs from a month ago as well at $64, $80 a share. So wow, this is going to be interesting tomorrow. Make sure you come back to the channel and I'll break it all down for you again and everything that's happened, because it's not just interesting to watch, it's also got a lot deeper meaning. You could kind of think of it as like David versus Goliath, because the street regulators, they are going to be pissed with this happening in their faces. And let's see if they go ahead and turn off the buy buttons again like they did back in 2021. And on that note, guys, we'll finish up here for today. Thank you very much for tuning in. Certainly interesting times in the stock market, and tomorrow could get even more diabolical. Let's see what Keith Gill has to say on his live stream, and let's see how the establishment tries to shut him down this time. Things are about to get spicy. Thanks very much, and I'll see you again tomorrow night. Cheers.